In Australia right now, hope is wearing thin. Families are under pressure. Mortgages are eating into take-home pay. Grocery costs are rising faster than pay increases. Rents are surging in cities and even regional areas. And as we approach a federal election, one thing has become crystal clear: cost of living and housing affordability are front and center in the minds of Australians. Amid all of that pressure, one source of hope continues to linger in conversations around kitchen tables and online forums: rate cuts. The idea that relief could be coming. That mortgage repayments might go down. That a little breathing room could arrive by year's end. But here's the real question: is that hope misplaced? Are rate cuts actually on the table in the near term? Or are we setting ourselves up for disappointment? In this video, we'll look at where things stand domestically, the influence of international monetary policy, particularly from the US, and explore what would actually need to happen for the Reserve Bank of Australia to justify cutting rates. Let's start by setting the scene here at home. Right now, the RBA's cash rate is sitting at 4.35%, the highest level we've seen since before the global financial crisis. That rate has hit Australian households hard. Fixed-rate loans from 2020 to 2021 are expiring into much higher variable rates. New buyers are being priced out. And investors are starting to rethink their strategies as yields tighten. Inflation has technically peaked, but it hasn't retreated back into the RBA's 2 to 3% comfort zone. Core inflation, the kind that really matters for monetary policy, remains sticky, particularly in services and non-discretionary spending. Think insurance, healthcare, electricity. These aren't categories people can cut back on easily. So, even though headline inflation has moderated, the RBA remains cautious. They've said, repeatedly, that they need to see clear and sustained evidence that inflation is heading back to target before they can consider easing. This is where the public and the central bank diverge. The public sees mortgage stress, cost of living pressure, and slowing spending, and they expect action. The RBA, however, is focused on inflation first. That's their mandate. And for now, they're not convinced we're in the clear. But this isn't just about what's happening inside Australia. The global context matters, and right now, that context is shifting. There's growing concern that the U.S.-China trade war could escalate again. With Donald Trump re-emerging as a political force and new tariffs being floated, there's a sense that supply chains could tighten, costs could rise, and global growth could be impacted. Some analysts have speculated that this environment, one where tariffs increase inflationary pressures while slowing growth, could lead to earlier-than-expected rate cuts. After all, if trade slows and inflation returns via supply chains, central banks might want to step in to cushion the economy. But there's a problem with that theory. Just this week, U.S. Treasury and Federal Reserve officials signaled no urgency to cut rates. Jerome Powell's message has been clear: as long as core inflation remains above target, the Fed is staying put. Even with market volatility and trade uncertainty in the background, the U.S. is prioritizing inflation control over economic stimulation. And when the Fed doesn't cut, it puts pressure on other central banks, like the RBA, to also stay firm. If Australia were to cut while the US holds, it could trigger a sharp depreciation in the Australian dollar. That, in turn, could reignite import inflation, weakening the very progress the RBA has made. This is why global monetary policy is so interconnected. Even though Australia faces unique domestic challenges, we're still tied to global capital flows, currency pressures, and investor confidence. So when, realistically, might the RBA cut? According to most economists, the earliest scenario for a rate cut is late 2024, likely around the November or December meeting. This would depend heavily on continued progress in inflation data, a visible slowdown in household spending, and signs that unemployment is ticking up slightly without triggering a crisis. Some more cautious outlooks push the first rate cut out to Q1 2025. These forecasts take into account the possibility that services inflation remains sticky, and that wage growth, though welcome, could risk pushing prices back up if it outpaces productivity. There are also political considerations. With a federal election looming, and the Albanese government under pressure to address affordability concerns, there may be indirect political pressure on the RBA to act. But the RBA has been working hard to restore its reputation as an independent body. Following the recommendations of the recent review, it's unlikely to bow to election cycles. One wildcard scenario is a deterioration in the global economy. If US markets falter, China's growth slows, or geopolitical tensions escalate, the RBA may consider a more dovish stance in coordination with other central banks. But that would likely come alongside broader economic concern, not ideal circumstances for households either. So what does all this mean for the average Australian? It means that while rate cuts aren't off the table, they're probably not coming as soon as many would hope. The path to relief is gradual and highly dependent on data. That said, there are early signs of change. Consumer sentiment is softening. Retail sales are slowing. Job ads are starting to dip. These are the signals the RBA will watch closely in the months ahead. The bottom line? Hope is not misplaced, but it needs to be measured. The RBA won't cut because people want them to. They'll cut when inflation is truly tamed, and when doing so won't reignite the fire. Let me know in the comments how you're feeling about your mortgage, rent, or financial goals right now. Are you planning for a rate cut, or just trying to hold the line? And if you found this helpful, like and subscribe for more grounded takes on the economy, housing, and Australia's financial future.